Hi everyone, Jeff Yasteen here. Make sure to hit the subscribe button and of course follow me on Twitter and on Facebook. Well, one of the things I like about the stock market is that, there's something for everyone. I mean, I like to speculate and trade in the direction of the trend. I do some day trading at times, but I also like making longer term bets, especially if it pays a solid dividend. So I'm getting paid to wait. So I'm looking for individual stocks that I think have good prospects and will move up in a big way, but are currently off Wall Street's hot stock radar, if you will. So I'll tell you about one such stock, in my opinion, in just a moment. But, right now, it's just lagging along, giving us a lot of opportunities to buy in at a cheaper price. And I do expect this stock to double in the next 2 years. But the key here is anticipate. I mean, if this were a hockey game, or to paraphrase the advice given to Hall of Famer Wayne Gretzky years ago, you want to skate to where we think the puck will be, not chase it around the ice like everyone else. Now, I'm not sure if Gretzky or supposedly his father ever really gave that advice, but if they did not, well, they should have, because in my view, it is the perfect metaphor for this kind of investing. So how do we go about looking for good stock ideas that are still off Wall Street's radar? Well, one method I like to use is monitoring the trades of corporate insiders. Now, not everyone knows this, but if you're a senior executive at a public company and you want to buy or sell your own company stock, you have to file a special piece of paper. It's called a Form 4 with the SEC, the U.S. Securities and Exchange Commission. So you can go onto the SEC's website and find all this data yourself. There are plenty of free websites that compile these insider trades every day. The point is, when corporate insiders think that their stock has been beaten down too far, they will, in many cases, start buying their own shares, their own company shares. To put all this in perspective for the stock market, the number of insiders buying their own stock right now across the whole stock market is very low. Most are actually selling their stock in large numbers, and they're taking advantage of the rise in the markets to basically cash out large chunks of shares and pocket the cash. But there is also the flip side. As you probably know, there are sectors within the stock market that have not participated in the market rally of recent months. Energy companies, the ones that drill for oil and natural gas, who maintain the pumps and refine the petroleum, and also manage the pipelines, have sat out the big rally. Since the start of the year, the S&P 500 is now up around 4%. Most energy stocks, as represented by this ETF, are down 40 to 50%, and some a lot more. But the insiders at these energy companies are sniffing a major opportunity to buy their shares while they're down. A friend of mine sent me this chart from Sentiment Trader. The line at the bottom shows us the ratio of insider buys to insider sells within the energy sector companies. The key part is at the far right side, where you can see that big spike. Buying this year among senior executives and board members, as you can tell, is off the charts for these energy companies. It's literally the highest that we've seen in many, many years. Meanwhile, what's happened to the price of oil? Well, most of us haven't really paid that much attention, but it's now above $40 a barrel. It's poked above its 200-day moving average, which is a good sign from a technical analysis viewpoint. Could the price move even higher? I think it could. To paraphrase an old saying, the best cure for low oil prices is low oil prices. So if you're a fan, say, of electric vehicles, and the fact is, so am I. Electric vehicles are the future, I believe. But like it or not, oil and natural gas is going to be a key part of our global economy for years to come. So you can still make money off this trend just like any other. So even before the pandemic struck, oil companies had been pulling back on their investments. That means existing oil fields aren't as productive in the future. New oil fields take years longer to bring online to production. And during the pandemic, energy companies pulled back even further. And how could they not in the face of plummeting demand when the price of oil was literally below zero, at least for one day? So next, I want you to look at this chart from the U.S. Energy Information Agency. It shows us the number of drilling rigs pumping oil in North America. And as you can tell on that far right side of the chart there, in May there were 339 rigs in operation. That's the lowest on record ever. And the fact is, in the last 2 months since this chart was updated, the Energy Information Agency in Baker Hughes says that number's dropped to 287. So it's even more of a record low for the number of rigs out there pumping oil out of the ground or out of the ocean. Let's look at one last piece of the puzzle, that is bankruptcies among energy companies. And there have been more than 30 this year so far, and of course we still have nearly half a year to go. So more than 200 energy companies have gone belly up in the last 5 years. They've declared bankruptcy. So considering all that, now we're being told that there is a slow motion economic rebound happening. It's taking place in fits and starts alongside the massive stimulus, zero interest rates, and COVID-19 flare-ups all around the world. So that means more people driving, more trucks on the road, more demand for oil to be refined into tires, plastic, and chemicals. So with that backdrop of this slow rebound, I don't think it's too much to expect another mismatch, this time with much higher oil prices from here, as traders anticipate lots of demand, rising demand, and not enough supply. So how do we play this? Well, one stock I like is Kinder Morgan. The symbol is KMI. They don't explore for oil and gas. They don't pump or refine oil or natural gas. Kinder Morgan is a pipeline company. They control 83,000 miles of pipeline. They also own nearly 150 terminals where that oil and gas is stored or shunted to customers' refineries, electric power companies, chemical plants, and all the rest. Now, Kinder Morgan senior executives have been eager buyers of their own stock. The founder, Richard Kinder, buys thousands of shares on a regular basis. Board members have also reeled in lots of shares along with the CEO of the company. Now, insider buying by itself is no guarantee that a stock will go up or go up immediately, but it puts the odds in our favor, and it shows that executives are willing to put their own money on the line and take the same risks as any other shareholder. But here's something else that I like about Kinder Morgan. Relative to what the company earns in the way of profits, and it does earn profits, its stock is at one of the cheapest levels in years. According to Wall Street analysts, the company is on track to earn 94 cents a share next year, 2021. Divide that into the current stock price and you get a price to earnings ratio of less than 20. Now, just a handful of years ago, as this chart shows, investors were willing to assign a much higher PE ratio of as high as 30 or 40 to own the stock. Now, as oil and natural gas prices rise from here, I expect that they will once again warm up to the shares and be eager buyers of the stock. So if we take next year's projected profits of 94 cents a share and multiply by a PE ratio of 40, we get a stock price of roughly $38 a share, or about double the current price of the stock. So there's one more kicker that you receive if you choose to own Kinder Morgan shares. That's the dividend. At the current price of the stock, you're getting a dividend yield of more than 7%. Now, that's one of the higher, relatively safe dividend payouts that you'll find among pipeline companies. Kinder Morgan announced the dividend increase in February. Now, they did it just before the pandemic struck, but since then, they've made 2 quarterly payments at the higher rate. So yes, there is always risk when investing in stocks. We have to keep that in mind. Dividend cuts, however unlikely, are one of those risks, but I find it encouraging, the actions of Kinder Morgan, even if the stock does not yet reflect it in its price. Likewise, I find it encouraging that the company's executives continue to add more shares to their own personal portfolios while their stock is cheap, and it raises the question that perhaps we ought to as well if we have a longer time frame about the shares and about the recovery of the global economy. If you like what I'm talking about, make sure to keep following me on social media and to subscribe to us on YouTube. I'm Jeff Yasteen.